Good morning, and thanks for being here this early. It's great to see all of you. I've been tasked this year to do the year in review, and what I'll be doing may be a little bit different, or quite different than what you expect. My goal is really quite simple. My goal is to convince you of three things, with data, I hope. One is that we're seeing the beginning of a major paradigm shift in terms of how business is being conducted, which is particularly important for us, in terms of the capitalization in this market, in terms of how companies are valued, in terms of how transactions are made, and that this is a real paradigm shift. And we are particularly vulnerable to this shift for reasons that I'll explain. The second is to convince you that there's a great opportunity in this, a great opportunity to succeed, but probably, unfortunately, a greater opportunity to fail. And thirdly, I hope to convince you that those who understand this and those who are prepared for this are in the best position to succeed, because there is a great amount of room to succeed as long as this is understood. And what I'll do is to try and show you data to support my thesis based on these three milestones that's relevant to all of us, whether you're a small company, which most of you are, with great innovation, or whether you're an acquirer, a mid-size or a large company. So I'll talk about this in terms of these three milestones, which is capital acquisition, partnership, and exit, presumably, and M&A. And what I will do, and I'll say this right now, is to spend 90% of my time talking about macroeconomics. And the reason is really twofold. One is we're no longer small enough to be in a different orbit by ourselves. We're consequential to and vulnerable to the macroeconomics, and few of us ever talk about that. And that's the second reason, which is that for the rest of the day, you'll hear about the microeconomics. Not that they're not important, they're terribly important. You'll hear about glaucoma and retina and so on and so forth, but it's really important to keep that in the context of the overall macroeconomics, because that really influences us. So let me dive into this. Where are we today? Well, there's a great deal of innovation. There's no doubt about this, particularly in our field, and you can see this in this meeting here. And innovation also means, for what I'm about to tell you in terms of the changing valuation, we're also particularly vulnerable. There's a great need to do transactions by large pharma. There's no doubt about that. There's a revenue cliff that they're all falling off, and that revenue cliff is upwards of $400 billion. But the good news is that there is more firepower in large pharma than there ever was in the history of this planet, which is over $500 billion to spend. The regulatory backdrop is mixed. You've heard about the IRAs. Luckily, we have an extraordinarily cooperative FDA. But the loose card here, may be the FTC, and we'll talk about that. But the headwinds are there, and we talk about these headwinds all the time, but what does that really mean? We talk about this biotech volatility, so let me kind of dive into that. And what we look at as a biomarker is something called the XBI, which all of you know of. The one thing that really is important to keep in mind is that the XBI is an equally weighted index, and that's important to emphasize. It's an equally weighted index. It was originated to showcase the small caps when small caps were doing really well. So it's entirely biased by the small caps. And one of the things that I will pose to you is whether that's really the index that we should be looking at to gauge how well we're doing. And there's no doubt that the XBI has done terribly. Since inception, there's been no 2 consecutive red years of the XBI until now. So it's not just the extent of the decline of the XBI, it's the fact that it's happened in a large period of time and that it appears to be functioning independently. It's specific to the XBI. Now, by definition, the XBI is going to be counter to the US Treasury for the cost of capital, but that disparity has never been greater than it is now, and maybe even more impactful to show you how important and independent this is. If you look at the 50-day moving average or the 100-day moving average or the 200-day moving average, you realize that this decline is really not a calamitous event or even a series of calamitous events. It's a steady directional change. It's a drip, drip, drip heading downward, and it appears to be independent of anything else. For the first time, what we're seeing is a shift of the XBI that appears to operate entirely differently from all other indexes, including the NASDAQ. Now, we in ophthalmology are particularly vulnerable to this We love to talk about innovation, and there's a great deal of innovation here, as you can see, but what that also means is that there's a great deal of small caps. We are heavily and almost entirely weighted towards small caps, so we are particularly vulnerable to these shifts. And not surprisingly, there's a great deal of red here when you look at these companies. So whatever I'm about to say in terms of the directional shift of the market, it may be more applicable to ophthalmology than almost anything else. And again, if you look at the ophthalmology index, not surprisingly, because of the small cap weighting, it follows the XBI index. So what does that mean? Well, it has a tremendous impact on financing. Again, shifted entirely by small caps, it also means that financing has changed. Now, it doesn't mean that financing has declined, it just means that it's changed. And it's changed almost entirely. If you look at opportunistic financing, it almost doesn't exist. That's why the IPO market is still as lagging behind as it is. It's not just depressed, it's almost dead, right? But financing does exist, it just looks different. Now what you have is financing that's not opportunistic based, but financing that's based on catalysts. And more of that in just a little bit. And that, again, affects us almost more than any other field because we are a field of small cap companies and we are a field of great innovators, and we're particularly vulnerable. So where are the large caps in all of this? Well, they're falling off a revenue cliff, and it's almost essential for them, it's almost desperate for them to do something to go ahead and make up for that revenue loss, and that's not going to come from their pipeline because their pipeline is totally anemic. So they have to do transactions, and that applies to ophthalmology as well. That revenue cliff is true of the leading ophthalmology companies as well. The good news, though, is that there's a lot of dry powder. There's a huge amount of firepower. There's never been a time in our planet when large pharma has had this much cash to spend, almost $500 billion in cash to spend. So at this point, you should be taking a pause and saying, how the heck does this make sense? How is it that we have all this innovation, we have this large pharma and acquirers that are desperate to do transaction, they have a huge amount of money, and yet the XBI tells us that things are really crappy and nothing is being done? How does that all make sense? Well, if there is a important slide that you want to take a picture of, I would say this is probably the most important slide of this talk because this really tells you the story, and this is why it makes sense. It's not that deals aren't being done, it's that deals are just different, and that's the paradigm shift. If you look at the bottom right, what you'll see is that the median size of the deals really haven't changed. Year to date is still $1.1 billion, but the type of deals have changed. The table on the left really tells the story. If you look at deals that are less than $1 billion, the deal count has gone down by almost 50%. The deal value has gone down by 34%. Now, that might be expected. You may say, yep, that makes sense. But what you may not expect is if you look at deals between $1 billion and $10 billion, the deal count has actually gone up by 60%. The deal value has gone up by almost 90%, and I bet you didn't expect that, right? If you look at large deals, now I know the N is small, but if you look at deals that are above $1 billion, the deal count has gone up by 100%, and the deal value has gone up by 364%, and I bet you didn't expect that. So deals are being done, but the targets are different. So what are the targets? Well, since 2022, 95% of all transactions that have been done have been late stage. Just think about it. There's only one transaction, one, and that's DICE. One transaction that's early stage. Isn't that amazing? Look at this chart and look at it from 2021 to 2023. There's a clear shift to the right. Right? Everything is late stage. Everything is catalyst based. There's one deal, DICE, in the entire year that was early stage, that was above $1 billion. But what does late stage mean? Well, apparently it doesn't mean the same thing to everybody. And the table on the left tells you that. And I find this really fascinating. If you're large pharma, your window of doing deals is immediately after proof of concept. That's where the majority of your deals are done, if you're large pharma. If you're a mid-cap acquirer, the vast majority of your deals are done late. The vast majority, almost 2/3, are done after the product is commercialized. And what's also fascinating is that in between, in other words, from proof of concept to commercialization, is barren. It's a no man's land. I mean, to me, this is fascinating. And I don't know if you have an explanation for this. I don't know if I know the explanation for this. It's fact. But I've got a hypothesis. And the hypothesis is, if you're a large pharma, and if you have a product, all of you right now, you're being followed. You're being looked at. They're following these products all the way through. And the time for them to strike, the time that's most consequential for them, is immediately after proof of concept, and that's usually human studies. Not at marketing, not after that, but immediately at proof of concept. And the reason for that is because they've got a platform. They can certainly put you or your asset onto that platform, and they want to be the ones to put the stamp on commercialization because they've got the infrastructure to do so, which makes sense. That's when value is at its peak for large pharma. Now, that's not the same case for the mid-size acquirers, because for them, it may be a new market. They may not have that infrastructure, and they want to de-risk themselves to make sure that they understand the market, they understand the market size, and they may not have the infrastructure, therefore they're going to buy the whole thing, soup and nuts, to be able to bolt onto their portfolio. So to me, that's the only explanation that I can think of for these windows of opportunity for when these transactions are done. But it still doesn't explain that barren area in between, which I find fascinating, which is from the proof of concept to commercialization. And you've got to ask yourself, why is it that nothing is being done here? I mean, this is totally barren, right? It's not because there aren't assets, there clearly are. Perhaps it's because of this slide. Perhaps it's because they know this slide. And I call this slide, yeah, heck, everybody wants to be a Regeneron slide, right? But there's only one Regeneron, and it's a unicorn. If you take Regeneron out, which is at the very top, and if you take Spark and Luxturna out at the bottom because it was acquired, there's not a single company in our field, whether you're an independent company, whether you're an acquired company, whether you've sold assets, where going from development to commercialization, your value hasn't been lost. Not a single company. So what does that mean? That means that we all underestimate the challenge that it takes to go from being a development company to a commercial company. It's an entirely different mindset, it's an entirely different company, and yes, we all want to be Regeneron, but, and I can say this with a joke because they're my friends, there's only one George and there's only one Len, thank God. But having said all of that, they're my friends, I'm sure I'll hear from them. But there's only one Regeneron, and Regeneron is really a unicorn. But maybe it's because of this that there's that barren land, because these mid-caps do know that if they wait long enough, this will happen and valuation will be better. And what does that mean for you? For you, that means that as a small cap, you better be thinking about planning your exit no matter where you are, and think about these windows because the goalposts are certainly changing. And the entire process is changing. Since 2019, 100% of transactions have been done by inbound interest for M&A. So the days when we used to think that, look, we got great results, we'll go out and do an auction, much like a fine bottle of wine in Sotheby's or what have you, and let's just have a bidding war and go to the traditional banker. Well, those days just don't seem to exist anymore. So 100% of transactions since 2019 by inbound interest, and the vast majority preceded by partnering discussions. The first mover almost always wins. So the first bid is almost always the final bid. There are very few additional bidders, and it happens very, very quickly. The majority happening within less than a month. And again, there is no auction here because maybe you get 2 bumps, maybe you increase by 20%, but it's not going to be 200%, it's not going to be 300%. So what does that mean to you? It means you got to be really, really careful about, it's not good or bad, but about who you collaborate with, who you partner with, because more than likely they're going to set your valuation and they're going to acquire you. There's going to be nobody else because there's such an enormous first mover advantage. So biopharma M&As begin organically, almost always. The first bidder almost always wins, and it's actually very rare to have 2 final bidders. And it's all catalyst driven. If you look at the major deals that are done, These are all the catalyst-driven deals. There's only one in ophthalmology, which is the Iveric Bio deal. The company valuation, and again, this shows you the power of catalysts, at the time that the phase 2 data came out was $1.1 billion. Once the phase 2 data came out, the company valuation increased by 143%, which was an unaffected premium of 66%. At the time of acquisition, the valuation increased by 220%, which was an unaffected premium of 64%. Now, what that says to you, regardless of where you are in your stage of development, is in a time like this, when the goalposts are shifting, you better be thinking about capital raise. You better be thinking about your entire strategy of partnering or not partnering, and you better be thinking about your windows of opportunity of exit, regardless of where you are, because these times are changing entirely, and you will be well rewarded if you do that in advance, and particularly if you can be catalyst-driven, because you'll be rewarded for having a catalyst. So in the last few minutes, I'll zoom in on ophthalmology, and again, I'm going to do a flyby, a 50,000-foot view of this, trying to put in the context of the macroeconomics. I'm old enough that I can remember where the entire field really was driven by anterior segment, glaucoma, dry eyes, et cetera, and then came along the anti-VEGFs. And we thought this trajectory would continue. I didn't think for a minute, and it's kind of, as a retina specialist, a little bit disappointing for me that I'd be standing here 30 years later still talking about only anti-VEGFs. We've had some massive failures, right? Fovista, lampalizumab, and that has caused that decline. But amazingly to me, now we're in the upswing again, largely because of these super anti-VEGFs. If you take that out, in our market, there are really only 3 assets that are approaching $1 billion, right? There's Tepezza, there's Oxervate, and Xiidra. That's it. So we're really driven still by these super anti-VEGFs. Now, where will that go? Will that trajectory continue with a new market with geographic atrophy, et cetera? Or will that disappoint so that it will have another downswing? I don't know, but what I do know is that as a group, as a community, we really should be hoping that they all succeed, because we will all benefit if they do all succeed, and I sure am pulling for them all to succeed. But our landscape has changed. Now, thankfully, we've had some stalwarts there, like AbbVie, like Roche, like Alcon, but we've also had some exits, for instance, like Novartis. We've also had some surprises in terms of people coming in, like Viatris and Astellas, but importantly, we've had some people on the sidelines that are still on the sidelines, massive groups like Pfizer, Merck, J&J, and so forth. So this landscape has changed and is changing completely, which is going to have a big influence on us, and for you, may provide a great deal of opportunity if you can set yourself up properly, as you've seen as these people come in. The wet AMD landscape, as I say, you know, the whole discussion is going to be different a little bit. I think it's really disappointing to me, and I really do mean this, that we're just talking about anti-VEGFs. I think we have a biomarker problem there, which is a whole different discussion. I'm really hoping that someone will be able to address the poor responders, someone will be able to address other mechanisms of actions. I realize faricimab is there, but we're still talking about super anti-VEGFs, and we're still talking about greater durability. And we'll have to wait and see if the trajectory is going to indeed be the super anti-VEGFs and the TKIs and then gene therapy, but hopefully we'll break through from the anti-VEGFs. I can't help but believe that in diabetes, anything that is non-invasive, whether it be topical or oral, is going to be an absolute breakthrough, regardless of what impact it's going to have. It's going to be a blockbuster. As far as geographic atrophy is concerned, look, there are 2 drugs in the market. I really hope both do really well, because for us, for this entire community, that would be great. It appears that that's the tail that's going to wag the dog, whether we like it or not. Clearly, it's a huge market. I think the questions are, with one of them, will the safety issues go away? With the other one, will a new company actually understand the market and be able to capitalize on the market? I think those are fair questions. But there's a lot of innovation behind, and I can't help but believe that at least one or several of these companies will succeed in this great market. But will that happen in time to keep that trajectory going? I think that's the question. As far as glaucoma is concerned, I was going to tell you a Jerome Bettis story. I guess I'll run over, but I'll tell you anyway. You know, I think of glaucoma as the Jerome Bettis of ophthalmology, and I don't know how many of you guys know who Jerome Bettis is, but I'm a huge sports fan. And Jerome Bettis was the bus for the Pittsburgh Steelers, and the guy is just the funniest guy, but also a really, really smart guy. And I remember watching this game. It was the playoffs. And it was in Three Versus Stadium, and it was just horrible weather. And it was Pittsburgh, I think it was against the Cowboys, and it was 4th and 3rd. And it was at the very end, and all they had to do was to get a first down, and Pittsburgh was going to win. And there's only one person in the back, and it's the bus. And the entire stadium knew that the ball was going to go to the bus. And the ball is handed to Jerome Bettis, and he's dragging 2, 3, 4 people, goes over, gets 4 yards, first down, hell breaks loose, Pittsburgh wins, everybody's running to the field. The reporter grabs Jerome Bettis, and Bettis grabs the microphone and says, if it's 4th and 3rd, give the ball to the bus. I'll get you 4 yards, guaranteed. And everybody's clapping and everybody's screaming, and the reporter's turning away. And then he grabs the microphone again, and he looks in the camera, and he goes, if it's 4th and 9, give the ball to the bus. I'll get you 4 yards, guaranteed. And I know all my glaucoma friends are going to be really pissed, but that's the way I think about glaucoma. It's like we're waiting for that breakthrough. We're waiting for Jerome Bettis. And we know what that breakthrough is. That breakthrough is neuroprotection. We all know that that's what it is, and it's going to change the world. But there are challenges to that in terms of endpoint, in terms of biomarkers, et cetera. Dry eyes, look, I don't even know if we know what that is. It's obviously multifactorial. I know it's been a bit of a quicksand over here. I'm waiting to see what companies that are restructured like Bausch & Lomb do. I'm really actually quite excited to see what happens in the anti-inflammatory field, whether we can charge that up. I think it's fantastic that we're looking at meibomian gland dysfunction. I think it's about time, but clearly that's going to be something that we'll wait and see. Rare diseases, look, it's been a disappointment, right, with Luxturna, and I think that's sour gene therapy. But having said that, there's tremendous innovation in gene therapy, and I can't help but believe that something will break through. But the rare disease market has really been taken off really by Dompe, who I really admire. Who would think that a small company, a privately owned company from Italy, would be kicking the heck out of everything we talk about in geographic atrophy and doing sales of almost $1 billion and creating a new market in neurotrophic keratitis, and also, obviously, Tepeza. Presbyopia, you know, I'm a retina specialist, and I really thought that if somebody had told me I'd be here 2 years ago, I'd say, look, half of this conference is going to be about presbyopia, and I've got to ask what the hell happened here. I don't know. You know, I really thought that this would be something that would just blow the market apart. I can't help but believe that the market still exists. Look, it's really a cosmetic market, so you know, pairs are not an issue. Everybody wants to look younger, and I can't help but believe that some of the companies that are following will have to succeed in this market. I think the myopia landscape is very much underestimated. There's great motivation from parents. It's a chronic disease. I think it's underestimated because people think that it's just atropine. Well, it's atropine without the AEs, and as soon as somebody can do that, this is going to be a tremendous field. Cornea, look, I think that Dompe with Oxervate has created a brand new field, which I really admire. There are others that are following. I think that will continue with innovation. There are others like Orion and others that are looking to disrupt the PK market. I think the challenge there is not going to be regulatory because the primary endpoints are clear. I think the challenge there is that there are only so many cornea surgeons. But I think the biggest challenge and the biggest question that I have is when will Big Pharma actually pay attention to this, right? Because there is a great work being done here. If you look at the ophthalmology transactions, look, the back and forth of Xiidra is there. But other than that, and I say this unfortunately, the only big M&A that we can think about is really the Iveric Bio M&A. And in historical context, unfortunately, there's a decade between these big M&As. And that's because we as a field really are so biased in a good way, but also vulnerable because we're almost entirely small cap. So just think about this. It's a decade between the Valiant B&L deal, which is above $1 billion, to the Iveric Bio deal. Nothing in between. And hopefully, the changing landscape that we see with companies restructuring with new companies coming in is going to allow us to have those big deals in between as long as the catalysts remain. The FDA regulatory backdrop, fortunately for us, is fantastic thanks to one person, and that's Wiley Chambers. You know, our job is to really keep him healthy and happy and continuing in his job and hopefully, out of jail. This is not a mugshot, but I was looking at this and thinking, can you imagine Wiley being interrogated by the DC police? Yeah, I moved drugs, but not those kind of drugs, But this is not a mugshot. But this is, we're very, very, very fortunate to have Wiley. And imagine the bail money. That bail money would come in right away. Imagine the number of CEOs that'd be sitting there going, yeah, sell the stock, sell them right away, get Wiley out of there. But they've been busy, right? I mean, you can see here the amount that have been approved, both devices and drugs. Maybe the two biggest misses, which are going to be refiled, thank goodness, is Healthegy and Outlook. But look, they're incredibly collaborative. This is a potential issue, which is the FTC. And I say this because I hate reading slides, as you can see, but I will read this quote because to me this is disturbing. And this is from Ms. Khan. This is not in regards to biotech, this is in regards to internet, but I'll read this out to you. It says, even if the FTC lost the cases, they would be a partial victory because the agency would signal that antitrust laws need to be updated. So to me, that's really disturbing. So to me, what that means, and we've seen this with the Horizon Amgen case, is that suits are now being thrown out, not because they are to be won, but messages are to be sent, right? And to me, that's a bit of a wild card. I will end where I began, which is I hope I've convinced you that there's a massive shift in the paradigm of how companies are valued, how deals are being done, how capital is being raised. There's great opportunity for success, unfortunately, a greater opportunity for failure. And I think companies that recognize this, adapt to this, adjust to this, and strategize properly and strategize early are very likely to succeed because there's a great need out there. I want to thank Maureen and Craig, as well as the ethicist team and Taylor and others for helping me with the slides and for putting on this fantastic meeting. You're going to be hearing great talks. You're going to be hearing great panel discussions. And you're not going to be hearing much about macroeconomics for the rest of the day, but I hope that you will hear all of those fantastic talks and panel discussions and keep it in the context of the macroeconomic world that we have to participate in. I hope to meet all of you in the networking sessions. Thank you for your time and thank you for your attention.